In this video, I want to talk a little about getting some bearish exposure to the market, not because I feel that the market's going to roll over, but just because I have too many bullish positions on right now and I want to get a bit of a balance in my portfolio. So I've looked at a couple of stocks and I've picked the ones that I believe are more weaker than the rest of the market, and therefore just to get a bit of balance in my portfolio, I'm going to put on a couple of bearish positions. Now I'm looking at HES. It's the stock chart is what you're looking at here on my platform. Now this is probably a more of an aggressive play because it doesn't look like a stock that is about to fall apart. You can see that it's actually been rising to the upside over the last couple of days on some very strong days to the upside. If we check volume, you can see volume is pretty strong in that last couple of days. It's been above average, and it is in fact above all of the key moving averages as well. So it doesn't really look bearish. However, I do feel that there's a bit of resistance up around these current levels. I'm not going to go into all the analysis that I've performed because some of the analysis that I've used, which is some of the Gann theory, is a bit complex to explain. But my basic premise for entering this trade is I believe there's a bit of resistance at its current levels. And for that reason, I believe that the stock may show some weakness over the next couple of days. And you can also see that the stock has a bit of resistance at its current trend line. The stock has been trending to the downside, although currently it's been showing a bit of strength as it's moved up and now is above all of those key moving averages. Now, if I show you the trade that I've actually picked for this, it's quite simple. I've just gone with a put option in this case. The stock at the moment is trading at 53.62, and I'm buying a 55.50 put for around about $230. Now I've bought 4 contracts to total an investment and maximum risk of around $900. Now my only concern with this trade really is, do I have enough time to be right on this trade? Now from my own prognosis, from my own analysis, I believe that the stock will find some resistance at its current levels and will start to trade back down. My target is around that $48 mark. So 48 is somewhere around about here. Okay, that's where 48 is. So I'm expecting the stock to start to move down now, back to around just below this $50 mark. Okay, now of course I could be wrong, and I've always said that we need to manage our risk in every trade. So for me, what's the level on the chart where I'm going to say to myself, well, I'm wrong on my prognosis, the stock's gone the opposite direction to my expectation and I need to exit the trade? Well, that for me is going to be above this trend line. Okay, so somewhere above $55. So if the stock starts to trade above $55, then I'm going to look to close this trade, and I need to work out what is my potential loss if the stock starts to trade above $55, because that's the technical level on the stock chart where I've said to myself I'm wrong and I need to close this trade. Now because these are short-term options, we only have 7 days in this trade, then the loss is going to occur a lot quicker because the options are going to decay a lot quicker as well. So if I move my mouse up around where 55 is, okay, it's around about this level here. Okay, now obviously it also depends on how quickly or how slowly, like how much time goes by before the stock actually hits 55, because options decay over time. So that's why we have these multiple lines. Each one of these colors represents a different timeline within the trade. Okay, so I'm just going to assume that we're sort of 2/3 in the trade, meaning that if it's a 7-day trade, maybe 3 or 4 days has gone by, and if the stock's trading above $55, then I'm going to lose somewhere around about that $500 to $550, okay, which is sort of in line with my risk tolerance. I am comfortable in risking up to 50% of my entry. Okay, so if it costs me close to $1,000 to get into this position, then I'm okay to lose $500 if the market goes against me. Okay, so that's my plan. So where do I want to get out? Well, like I said, my target for this trade is somewhere around about this $48 mark. So what I like to do is I like to look at when does this position double in value, meaning if I've spent $900 to get in this trade, well, where can I make a profit of $900, which would be a return of investment of 100%. Now, for me, for my criteria, that needs to be before I reach my target. And as I've said, my target in this case for Hess, H-E-S, is $48. So long as I reach a 100% return on investment before I get to 48 in the stock chart, I'm happy. Now you can see with 3 days left in the trade, the stock only has to move down about 4.9% to 51 for this position to yield a 100% return on investment. So that's in line with my prognosis. Remember, my target is lower than 51. My target is 48. Okay, my target, as I said, is below this $50 mark. The stock right now is trading at around 53.62. Okay, now on this graph, it's calculated that the stock, this position, will double in value, meaning a 100% return on investment, which for me, for this position, would mean a profit of $908 when the stock reaches 51, okay, which is above my current target on the way down. So that's good. That means I can actually exit this trade before I even reach my target. And I may decide to do that depending on how my position is performing and how long or how quick the stock takes to actually meet that target level. Of course, if I'm wrong and the stock actually trades higher, then I've said to myself, I'm going to exit this position for a $500 loss, okay, or a little bit more, if the stock starts to trade above 55. So that's how we're going to manage this trade. Now, I want to talk a little about something I haven't spoken about in the past, but is very, very important when it comes to options trading, and that is volatility, okay? You can think of volatility as the demand in the options, okay? Here's a chart on the left-hand side of volatility. This is volatility only a couple of days ago, or a couple of weeks ago. This is back on September the 13th. Now, volatility got as high as 90%, right? That means the cost of those put options were incredibly expensive. That's what volatility does to options pricing, okay? Volatility is a factor when options are actually priced, in addition to the stock price. Now, if I go back on the stock chart to the 14th of September, I would expect that the stock would have actually had a massive decline, which is the reason for an increase in volatility like that. So let's try and find where's the 14th of September. So you can see the 14th of September is here. You can see that the stock has been moving down dramatically all of September, which is why volatility increased during that time. Okay, so this is September here. So there's the down here where my mouse is. Volatility on the 2nd of September was around 35%. Okay, now during the month of September, it got as high as 90%. So that's incredible. Now that does wonders for people who have bought put options, okay? It increases the value of put options. You can see that by this chart here on the right. Notice that here's the price of volatility on the left-hand side here. And as volatility is increasing, look at what's happening to our profit. It's moving to the right-hand side, meaning that we're getting more and more profit. Now that's great. Okay, because that means even if the stock doesn't move and volatility increases, which is highly unlikely, volatility increases generally because the stock price is moving, or there's a bit of demand in those options, which occurs in earnings times. But in this case, volatility increased in September because in September, the stock price fell dramatically, okay, from $55 all the way down to $45, okay? Fairly large move down in terms of a percentage. Now, think of that. Let me try and explain why that occurs. Now, think of a put option as insurance. If you have a cyclone coming around the corner and you don't have insurance, and then you're looking to buy insurance, well, that insurance is going to be expensive, okay? So that's what's going on here. As this stock's moving down, people wanting to buy this put option, which is like an insurance on their stock, and therefore the demand of those put options increases, which means volatility increases, okay? And that's how the floor traders are, increasing the price of these options, okay? Now, what that means for our position is that if, for example, the stock starts to come back down again, so right now it's trading at around $53, well, if the stock starts to come back down, closer to 50 and breaks 50 closer to 48, well, volatility is going to increase. That's the expectation, okay? So volatility would increase. Now, we don't know by how much, but we can certainly put together some sort of forecast or some sort of prognosis. Maybe right now, volatility is somewhere above 40. So if we look at the graph, it's about 42. Let's say, for example, it goes up by, I don't know, maybe 10% or 20%. So maybe it goes up by another 8 points and therefore goes up to 50, for example. Well, on my platform, I can give some type of forecast of what that impact will be on my positions, which is why I like to buy put options when I have a prognosis, an expectation that the stock is going to go lower, okay? Now, it's very important that you don't misunderstand what I'm saying here, because if the stock has already started to go lower, it's already started to make that move, well, then volatility is already going to be priced into the options, meaning that the put options are already going to be overpriced. But in my case, the stock hasn't made any move down just yet. It's actually been moving up. So I like to buy put options when I have an expectation that the stock is about to move down, but it hasn't moved down yet, okay? So it's a bit of an advanced strategy, but it's certainly very advantageous if you have a system where you can actually forecast and predict and create a prognosis of a move to the downside in a particular stock while the stock is still moving up. Because if that's the current status of your position, then that means volatility is yet to be priced in, and your position will benefit by that increase in volatility as the stock price moves down, which will then, in fact, give you greater profits, okay? So it's like a double whammy. You get a profit because the stock's moving in your direction, and you get a bit of a boost in your profitability because volatility is increasing, furthermore helping the profits of your put option because the value of those put options are increasing as demand builds for those put options, right? It's like a cyclone. Cyclone's coming. People want to buy insurance. That insurance is getting more and more expensive, okay? So we can, using this platform, and most platforms have this type of capability, we can see what happens to this put option without any stock price movement just by the increase of volatility. And what I'm going to do is I'm going to increase volatility by about 20%, okay? Just to show you that impact on the stock price. Sorry, not the stock price, but on this put option, okay? So let's have a look. So you can see it's given us a 10%, almost 10% boost just by the increase in volatility. Now, that's only a small 20% increase in volatility, but you can see back here, volatility went from low 40s all the way up to the high, all the way up to 90, like doubled, right? So it's like moved from 40 all the way up to 90, more than 100% increase in volatility. So why don't we try and see what happens with a 50% increase in volatility? We won't go as high as 100% because we don't know if that's going to happen. But a small 20, 30, 40, or even 50% increase in volatility as the stock price is moving down is certainly going to boost our position, right? So you can see just by this increase in volatility, we've boosted our position by 20%, okay? So volatility is going to help us, going to help our put options if we are right on our prognosis and the stock actually does in fact start to come back down, okay? So that's what I wanted to talk about, but it's also important that we don't buy put options when a stock has already started to move down. Why? because those put options are already too expensive, and the stock will have to move a lot further for you to make any type of profit in your particular position. Okay, so it's very important that you understand that. So we'll monitor this one as we go for the next couple of days, and obviously for me it's important that I look at this closely because I've only got 7 days in this trade. Now that's in line with my prognosis. I do believe that if HES is going to make a move to the downside, it's going to happen sometime next week. So that's why I've gone with short-term options. It's a bit more of an aggressive play, but hey, let's see how it goes out. The other one I'm also looking at to the downside is Netflix. Where's my Netflix chart? Let's see. I think it's this one here, right there. So let me bring up Netflix. Now I have a different trade on Netflix already where I've sold some call options. So go and look at that video. It was posted a couple of days ago. But this is another more aggressive bullish play on Netflix, on the expectation that Netflix is going to start to trade back down below and maybe get to somewhere around about this $90 mark. Okay, a fairly aggressive play. So obviously I could be wrong, and I need to have some sort of trade management plan in place. So for me, if the stock starts to trade back above this $100 mark, then I'm going to look to exit this trade. So let me talk about what are the options that I have selected for this downward bearish play in Netflix. Let's see, here we go. So I'm going to talk about the risk graph first, and then I will talk more about how I've constructed the trade. Basically, if you look at this risk graph, you can see that Netflix is right up here at around the $100 mark, and it's indicated here by this blue line. Okay, that's the current price of the stock. You can see that as the stock moves down, then my profit, which is indicated here by the right hand side on this chart, is increasing. Okay, so the first thing I'm going to do is look at where does this position double in value. You can see that it doubles in value, meaning a return of 100%, somewhere around that $90 mark, okay, which is where my target is. Now, I do believe that's a bit aggressive, okay. I don't know if Netflix is going to get to that, given that it's above all of these key moving averages. However, it's an aggressive play, and that's why I've got that other trade where Netflix just has to remain below $100, which is because I've sold some call options, and I will get to keep that credit. So go and look at that video. It's a non-directional trade where the stock just has to sort of stay where it is right now and not even get to any target for me to make that profit. But in this case, it's a more aggressive play. It's a directional trade where the stock has to move down to a specific target for me to make some profit. Now, the great thing about this trade is that I've created for myself a net. Okay, if you look at this trade, you can see that it's a big range of profitability in this particular trade. So long as Netflix is below $92 and above $67, well, I'm going to make some sort of profit, and that's the idea of this trade. My target on the technical chart is that Netflix will probably get to somewhere around that $90 mark. Okay, and if it does that, well, then I'm going to make a nice 100% return on investment. But the stock could get anywhere below that, and I will still make a profit, such that I've got a bit of a net, and I'm trying to catch where this price is going to move down to. If you look on the left hand side, here's where the price, I'm sort of trying to forecast that the price is going to fall in to somewhere around where my net is to allow me to have some sort of profit. Okay, so while I've got a target of 90, I can actually make a profit anywhere within this net. Now I might play around with this until I find one that maybe I'm a little bit more comfortable with. I may move this net up maybe to where close to where the stock is right now, okay, which means I may need to pay a little bit more to get into this position. Right now I'm paying $282 per contract, so I'll probably invest 3 or 4 contracts for this position, okay, because I like to invest around about that $1,000. Now you can see that where, you know, as I said, I need a place on the stock chart to get out of this position if the stock, in this case Netflix, starts to trade higher, which is against my expectation. It's against my prognosis. Now for me, that's going to be around about that 102 level. Okay, so I need to look at my risk graph. If I'm above 102, what sort of potential loss am I going to incur? Okay. Now, in this case, let's see, 102 is around, let's see, I'm trying to get that as close as possible. So it's probably around about the 130, yeah, so around about 120, 130, okay, which is in line with my risk tolerance level, because as you know, I like to risk up to 50% of my investment. So if I have invested 282 per contract to get in this position, well, I'm happy to risk up to $140 per se per contract. Okay, so I will stay in this trade even if it goes up around that 102 level, but then if it starts to trade above that 102 level, I'll look to exit this position. Okay, and I'm expecting that Netflix is going to go down up to around about that $90 mark. Now, one thing that I'm a little bit cautious of is that earnings is coming up. You can see it says that here. Earnings is coming up somewhere in about 17 days time. Okay. Now this trade I think is a 21-day trade based on the options expiry. So I've got 21 days to beat in this trade, but most likely I'm going to want to look to exit before release of that earnings report, because I don't want the stock to jump too high or too low. So I'll evaluate that depending on how the stock's going in a couple of weeks time to determine whether I want to get out of this trade or not. So here's the options that I've actually bought and sold. I've bought a bunch and sold a bunch to construct this particular risk graph. So I'm going to look at doing a total of 4 contracts of this position and look to get in this sometime on market open. So I'm going to just save that, and that may be a little bit more than what I normally invest, so I might actually just see $1,100. That's not too bad, so I might just leave it at 4 contracts. So we'll monitor what happens with Netflix over the next couple of days as well. Now, as I said, it's a more aggressive trade, so it's one that I do need to monitor pretty closely and manage very, very closely as well, because currently the Nasdaq and the S&Ps are all going up to making new highs. Okay, and Netflix is part of the Nasdaq. The Nasdaq has been very strong. If you look at my trades on Amazon, my trades on Apple, they've all been strong. My trade on Priceline, these are all been to the bullish side and all have been making new highs. Now Netflix is part of the Nasdaq, so I'm going against a major trend, okay? But I'm going with what the technical chart's telling me. That's how I trade. I don't care what the sector's doing. It's good that you trade in line with what a sector's doing, but I generally trade in line with what the stock chart's telling me. Now, for me, the stock chart's telling me there's a bit of resistance at $100, which means the stock may go slightly sideways to downwards. Okay, this plays a bit more aggressive because it's expecting the stock to go down quite a bit, 8-9% in the next couple of weeks, which is, maybe not so likely, but certainly possible. And so the way that I trade is I put on my positions and I manage them. I manage them hard. I'm disciplined in my trading. I don't let the emotions come in. Okay, I set for myself in advance how I'm going to manage the trade, and I follow those rules, and that's it. Either the trade works or the trade doesn't. And the goal is to ensure that you have more winning trades than losers. And if you're managing your losses, then in the long term, you have a winning system. Okay? But as I always say, know your risk. Only invest capital that you can afford to lose, and always manage your risk.